Welcome back. You are watching the Budget Countdown. Deloitte India has said that greater support to MSMEs ensuring access to alternative energy supplies could help India navigate the trade uncertainty on the back of Trump's tariff policies. It has also said that liberalized export rules and impetus to the infrastructure should be a priority when the finance minister presents the union budget on the 1st of February. To discuss this further, I'm now joined by MS Money, partner at Deloitte India, Rumki Majumdar, economist at Deloitte India, also with us. Coming to Rumki first, what according to you will be the economic outlook for FY26 and FY27 in the upcoming budget? Fiscal deficit targets and what could be the year-end situation?
Right. Thank you so much, Timsy, for having me here today. We are very optimistic. I mean, at the start of FY25, we were not so optimistic given the challenges that we were seeing. But given the proactiveness the government has shown over the last few months, be it tax exemptions, GST push, the monetary policy push, and the reforms that they have brought about, and India has kind of grown at 8%, which no analyst actually could have expected. So the economy started on a very strong footing. The third quarter is likely to be very strong given the GST impact that would be felt in that quarter itself. So if 3 quarters are strong, we believe that the growth could be anywhere between 7.6% to 7.8%. So we are very hopeful there. Next year it's likely to be a little modest because global uncertainties, trade uncertainties might weigh on it. But given that tax exemption will continue to have some impact on boosting demand, so I think that's where it will cushion off impact. More importantly, what we are expecting that the government, which took a big bet on giving the fiscal push, will probably have impact on its revenues. But what is important for the government is that it will try to keep the fiscal deficit for the year on its target, because that gives a very important signal to the investors, global investors, that it has control over its finances. So I think it will try to keep its target of 4.4% this fiscal year, and maybe another couple of point percentage points lower the next fiscal year.
Getting in money in this conversation, as you rightly said, that some pressure coming on taxes because of rationalization. So, Mani, what are your expectations both on direct and indirect tax collections? Because currently they are behind the target.
Look, when it comes to direct and indirect taxes, both these are very intricately linked to the economic activity in the country. When you talk of direct taxes, for instance, if the economic activity is great, and we have firms which make more profits on account of that, the income tax collection goes up. When it comes to GST, the correlation is even more direct, because if there are more goods and services which get consumed all across sectors, all across the economy, the tax collection goes up. So the recent decline that we have seen as far as GST collection, for instance, where it has moderated a bit in the last 2 months, is to my mind a very, very temporary measure before things pick up. The larger messaging that I would watch out for is how is the economy doing and what are the economic parameters doing? How are various sectors doing? How is real estate doing? How is auto doing? How is infra doing? Now, if these sectors, if the 4 or 5 big sectors, which are big contributors to the economic growth, to employment, and to the collections, if these sectors are all in firing mode, in that case, I think it's just a question of timing before the tax collections pick up, both on the income tax side and on the GST side. In the GST side, the rate rationalization that we have seen has been so dramatic that it will take a bit of time for tax collections to catch up and go back to the earlier levels. If we see last 2 months, for instance, the decline in GST collections has been pretty moderate compared to what many people were expecting. And possibly in the next 2-3 months, we will again see the collections going up a bit. So I'm very positive in feeling that at the end of the year, we will possibly meet the tax collection target set for the year. And by the end of the year, that will also result in the fiscal deficit, which is estimated at 4.4, to possibly nudge closer to 4.3.
So So as Mani was pointing out, that both the direct tax and indirect tax numbers should stabilize very soon. Getting in Rumki back in the discussion, and as Mani was reflecting that, tax collections should be okay, and Rumki was saying that, when it comes to overall scenario, Rumki, geopolitical situation is changing. There are several risks. The US trade deal is still in talks. What are the economic risks that India is facing currently? Because you did mention that some sort of a stability on the fiscal deficit side could give that comfort to the foreign investors. But overall, how do you see the situation currently?
So geopolitical developments are like it's kind of impacting Indian economy in a large way because over the last 1 year we have seen huge amount of capital outflows. Be it FPI, entire FY25 saw about $18.5 billion flowing out. Gross FDI, which was the highest till between April to October, was the highest in 5 years. But if you look at the net FBI, it was only $6 billion, was second lowest in 5 years, and all because high repatriation. Clearly, the fact that we have almost about 50% tariff for many of our exports to the US, the fact that we have still not come to a trade deal with the US, all of these are weighing on the investor's mind. So having that US trade deal done is very, very important for the government to give that assurance that yes, economic fundamentals are good and so is the outlook. So I think that's where the government will be. That's why the government is kind of ensuring that it's not about if, it's about when. We will expect some of this uncertainty to flow into the next fiscal year, but I think the government is doing a fantastic job in diversifying the trade market. Look at the number of FTAs that we have signed, all 3 FTAs with the UK, with the New Zealand, with Oman. One FTA got operationalized, and one we initiated with Israel, and quite a few are actually in the advanced stage. So these trade deals are also ensuring that some of the impact of US trade deal get cushioned away. But clearly, we have certain risks coming our way, especially if suppose US slows down and we do not get enough exports done to the US. It can have an impact on our current account, on our currency, on our reserves, etc.
Getting back to money, since Rumki was mentioning that a lot of trade deals have happened, but when it comes to tax reforms, we've seen a lot happened last year itself, be it the personal income tax side, be it the GST rationalization or the rewriting of a simplified new income tax act itself. So what are the major tax reforms that you think the budget will talk about, both for direct and indirect taxes, and keeping aside the customs area, because that government has already expressed an intent on?
From the income tax side, there is a need to further simplify a lot of provisions to do with the tax reduction at source. We have multiple sections, multiple rules, multiple exemptions given in respect of the TDS provisions. So there is a need to look at that and possibly categorize them into 2 or 3 broad, buckets. One, let us say, for all the goods and all the materials that get sold. One for the services, and one maybe for the digital services. There is a need for simplification over there. When it comes to the indirect taxes side, I think the stringent need right now is for us to improve ease of doing business parameters through the customs duty route. Import of goods or export of goods from India has become very simple over the last few years, but are we there in terms when we compare ourselves with the other benchmarks globally? We are certainly not there. So there is a lot that can be done. So for instance, in customs, similar to GST, why can't we have fewer rate slabs in customs? Why can't there be 2 or 3 just slabs which are there in customs? Similarly, on the customs duty side, why is there a need for an SVB provision which talks of related party transactions? And related party transactions typically have been subjected to a special customs valuation branch, which to some extent, many people in business also feel it is outdated now. Now, linked to the need for treating the associated party transactions at par with other domestic transactions, is also the need which can cover both direct tax and indirect tax, where similar to many other countries, we bring in some kind of a group entity concept, where an organization is taxed at a group level, and therefore intra-group transactions are typically not taxed, or intra-group transactions are ignored when it comes to taxing. This also gives us the flexibility for various organizations to move goods and services between their group entities instead of worrying about which is profitable and which has a larger tax outgo, also which has
definitely
a
money
tax credit pool and which does not have.
Definitely, that's a long wish list that you have in terms of reforms. But TDS reforms features in most of the industry wish list, and so does customs and ease of doing business reforms. And with that, let's see what actually finally comes on the 1st of February. But definitely these wish lists are on the radar of the government. And I'm sure you guys have yourself also given that the detailed note to the government to look into these areas. And I'm sure they must be finding some more time to go through it. And with that, it's a wrap on this special broadcast. Thank you for watching. Stay tuned to CNBC TV 18. The news continues on the other side.